Hello and welcome to Capital Ideas TV. I'm Mark Bunting. We're going to be bringing you the most actionable investment ideas based on the very best research and data. Coming up on the show, we have the CEO of Legend Power Systems and the CEO of Smart Employee Benefits. Contributor Fabrice Taylor casts a skeptical eye on marijuana companies Aphria Inc. and Cannabis Wheaton. You don't want to miss this. He speaks his mind. It's very compelling. First up, we have Ralph Garcia. He's an analyst with Echelon Wealth Partners. He has a top pick rating on Pivot Technology Solutions, and he says these shares could go more than 200% higher. So Ralph, you've got a top pick on Pivot Technology Solutions. You've got a 550 target price, which gives it lots of upside potential. They're in IT, but a lot of companies do that. So what kind of IT? What do they do exactly?
So they're a value-added reseller or a VAR, and if you look at the spectrum of IT services, you have the value-added resellers on one end that they'll sell hardware, software, they'll integrate and install it at a client. And then you have the companies like CGI Group that do full IT outsourcing for companies.
So Pivot competes with a lot of different companies. How do they differentiate themselves in that sector?
So it's one, the breadth of products, and two, just their scale. I mean, at $1.5 billion in revenue, they can support some of these product lines across the US and into Canada. And really their skill set on integrating those different products from whether it's a smartphone and laptop on one end all the way to a data center and implementing a hybrid cloud for a customer.
I see that they have a lot of Fortune 100 companies as clients. Can you give us some names that people would know?
Yeah, I mean, Pivot itself has been around for 5 or 6 years as an entity, but the 4 companies that they merged together originally have been around for 15 to 20 years. So they have long-standing relationships with companies like Apple, AT&T, Home Depot, Ford, Microsoft. I mean, these are all customers that would buy hardware at some point in the year from them, and then they would install it for those respective customers.
That's an impressive list. Now, the management team is fairly new. Give us a sense of their background. Have they done it before? Have they been successful elsewhere? Who are we talking about here?
That's a great point you brought up. I mean, Kevin Shank is the new CEO. He's been there just on a year now as CEO. He had consulted to the company for about 6 months before that, and he's got the pedigree you want for a CEO of this kind of company. He came from GE IT Solutions that got acquired by CompuCom, so he was running a large value-added reseller. At the point that CompuCom got sold the last time to private equity, he was doing $2.2 billion in revenue. So Kevin knows how to grow large resellers nationally in the US and Canada, and really how to grow the managed services business within that kind of company where the higher margins are.
Pivot's EBITDA margins seem quite small on the surface, 2%. You think they can grow? Give us a sense of the growth possibility here.
Yeah, the key here is if you can grow the managed services business. If you're just selling hardware, that's a 10% gross margin business. If you can sell that hardware, implement it at a customer site, and then maintain and monitor that particular network, you can grow the managed services business, which is 30% gross margins. If you can grow that as a percentage of revenue, then your EBITDA will go from 2% to 3 or 4%, depending on the percentage of revenues that the managed services makes of the total.
How big is the dividend yield right now, and is it sustainable?
The dividend yield right now is about 7.5%. It's a 16-cent Canadian annualized dividend. Definitely sustainable. I think the board's committed to it. The company has the cash flow to support that. I don't think you'll see a dividend increase because the company has aspirations to do more acquisitions as we go forward. But the dividend, with 30 million or so US in EBITDA, there's enough to support CapEx, interest payments on the debt, and maintain that 16-cent Canadian dividend.
And Ralph, what are some of the tailwinds for this company within the sector, economically speaking and otherwise?
I think the migration to cloud is going to benefit them as companies either want to go to a public-private cloud, a hybrid situation. They would hire Pivot to do either the install of the data center itself on premise at the client site, or to integrate that particular network with an Amazon Web Services or a Microsoft Azure. So you've got these dynamics happening on the IT spending side where maybe you're not spending on a physical data center and you want to create this cloud infrastructure within your network. The move to mobility, cybersecurity issues. I mean, you've got all these these trends on the IT spending side that'll keep generic spending growing at 3 or 4% a year, and they'll be able to benefit from that.
And lastly, for shareholders or potential shareholders, what would you say to them in terms of why they should buy this stock? Well, what's compelling about it?
Right now, you're really betting on Kevin Shank and his playbook, and can he grow managed services from 10% or so currently to 30% of revenue in 2 to 3 years? If they do that, or if he's successful in doing that, you'll see EBITDA margins go from 2% to 4%. And every percent in EBITDA margin, given a $1.5 billion US in revenue, is $2 in value to the stock. The beauty is Kevin's brought 16 of his senior reports that used to work with him at CompuCom to pivot. So I think you've got the right quarterback, you've got the right coach calling the plays. So it's, I think they'll be successful in integrating that playbook.
Investors usually like it when officers, directors, and other insiders are buying a company's shares. That means they have a vested interest, they've got skin in the game, and they believe in the future of the company. Let's give you a few examples here. We'll take a look at Badger Daylighting, which took a big hit here a while ago after a short seller had some negative comments, but some insiders took advantage of that. We'll tell you about that in a second. First up, though, Paul Vanderberg, the CEO, buying shares back in October at prices anywhere below $32. But 6 different insiders between May 16th and May 30th, after the stock fell, have been buying in. So that should be good news for Badger shareholders, these insiders believing that that's a good opportunity to buy. Let's take a look at ECN Capital. You've got the president, Mr. Nikopoulos, buying about $2 million worth of shares back in November, and then here another $3.5 million worth of shares in May, and a director, Mr. Stoyan, 74,000 shares buying of ECN Capital, and Nikopoulos owns 6.5 million shares. He's actually increased his stake in the company recently by 119%, so some insider buying there. Now, our contributor, Fabrice Taylor, has been stirring things up in the marijuana sector. In fact, the CEO of Cannabis, Wheaton, is in a bit of a flap with Fabrice on Twitter. He's challenged him to a debate. Fabrice has accepted. We'll see if it happens. If it does, we'll try to get him here. But Fabrice has some very compelling things to say about Cannabis, Wheaton, and Aphria. Fabrice, your motto is be early and prosper. Were you early in the marijuana sector, and did you prosper?
I was very early in the marijuana space. I was in a couple of the big ones privately, and of course benefited from the first wave of enthusiasm, sold my stocks, never recommended any of them. I sadly missed most of this latest wave, which you were spot on about last fall. Didn't really participate. I own a couple of small positions. It's been good to me, but I wouldn't want to re-enter it right now.
One of the most successful companies and one of the biggest is Aphria, and they owned 17% of Cannabis Medical. Cannabis Medical a few weeks ago fell one session by about 16% on no news. It was kind of mysterious. You did some digging and you found out what actually happened there.
Yeah, I mean, I owned the stock and I was curious as to know why it was down so sharply, so I started investigating and I called the company and they said that Aphria was selling its stock. So I started poking around in Aphria and I came up with this notion that the company is behaving more like an investment fund or a hedge fund, and a very short-term one at that. So they bought into this Cannabis Medical company late last year at $1.40. That alone is perplexing because the stock never traded there, it never got that high. Usually when you do a private placement, it's at a discount to the market price. They did it at a premium. That's weird. A few months later, they sold 500,000 shares, bought it back 5 days later for more, and then they blew out 2.5 million shares in May. That took them to below 10%. So we don't know what they're doing now. They may be all out. The stock is still under pressure. I suspect, though, that they crossed that 2.5 million shares to a short seller, because who would buy that much stock? I think it was somebody who was shorting the stock, driving it lower, and then covering their short with Aphria stock.
So why is Aphria doing this, and have you talked to the company?
I have not talked to them yet. One of the founders of it reached out to me. I haven't had the time to pick up his call yet, but I don't really know. I find it very baffling, though. I mean, they have made money on some of their investments. There was another one called Mass Roots, an OTC deal. They were in it and out in a very short period of time, and they doubled their money. But they make $250,000. This is a market cap of hundreds of millions. That doesn't move the needle. I don't understand why they're doing this. I have some suspicions, but it doesn't make sense to me. They're fully funded for their growing operation. They don't need any more money for that. It's being built out. But they're raising a lot more money beyond what they need, and they're using it to invest in penny stocks in this space. And my suspicion is that somebody's benefiting from these trades. I mean, if you're in these penny stocks before Aphria announces their placements, and which drives the stock price higher, you're going to do very well. So I'm not suggesting anything untoward from the company, obviously, but it's just suspicious, and there are people who keep showing up in these little penny stocks.
Any names?
Well, there's a company called the DeLavico Corporation. They put together Aphria. I know that because I was in that one early, and they are popping up as investors and consultants to some of the companies that Aphria has invested in. So again, don't know what's happening there, but clearly the opportunity for profit is there, and I think it's very bad optics for Aphria to be doing this. It doesn't reflect well, in my view, on management.
Especially if they're meant to be a grower, pretty well primarily, and to be one of the biggest in Canada and the lowest cost producer and so on. Now, I should mention that you sort of stirred things up on BNN recently on Market Call with this information. You also stirred things up on Cannabis Wheaton. Now, Andrew Willis in the Globe and Mail did a piece on them. So Cannabis Wheaton, what's happening there? And I should say that they're trying to be sort of like a Silver Wheaton, a streaming company in the marijuana sector.
Yeah. Look, if you were going to ask someone, could you write a parody of the medical or the marijuana financing scene, this is probably what you get, right? Like you get, how do we do a deal and make it different and attract attention and get a huge market cap and make a ton of money for ourselves when we have stock that we bought at 2 cents.
What I said on BNN was, I was sort of half joking. I said if you were going to do a parody of a modern mid-2017 marijuana deal, this would be it. You take a name that has a certain meaning, it implies success, you take a business model that's different. You're not a grower, you're a streamer. Streaming is common in mining. Silver Wheaton is a very successful streaming company, and they basically give a mining company money, and in exchange they get to buy some of their production at low prices for, sometimes indefinitely, sometimes for a fixed period of time. And I can tell you this, mining companies don't like to do streaming deals because they're not good for them. They only do them when they're desperate, generally speaking. They do them when they can't get equity financing. So it's not their favorite way to finance, but sometimes they have to if they need money outside of the cycle, when the cycle is at a low ebb. So right off the bat, I think that it's a questionable business plan because anybody can raise money right now in marijuana. So if you can't raise money and you have to resort to a streaming deal, you're not a very promising company. Okay, I think we can all agree on that.
The CEO of Cannabis Wheaton isn't thrilled with your comments, and you've had a bit of a Twitter dispute.
We're having some fun on Twitter. He wants to debate me on BNN. I said, fine, pick a time and I'll be there. I'd have some questions for him. How many shares do you own and what did you pay for them? I already know that, but I want him to say it. I'd like him to tell us who his secret partners are, because there are promoters behind this deal who are, very clever people, well-known promoters, but they're not long-term investors. They're not business builders. They're people who are in very early and out very early. And unless you're investing along with them, like he is, you're not going to do well, generally speaking.
First off, if you do the debate, you do it here at Capital Ideas TV, right?
Okay, you're on.
Anything you haven't mentioned you want to touch on either company, Aphria or Cannabis Wheaton?
Well, I think that, it's sort of hard to grasp this concept, but Aphria, to my mind, has admitted that its stock is overvalued. It doesn't need money to be a grower, which is its stated mission. But it raised money anyway, and it's taking this money and it's frittering it away on some of these deals that it does in penny stocks. And that to me is an admission. Our stock is overvalued. Let's raise a bunch and mess around with it. You don't need Aphria to buy penny stocks for you if you're an Aphria investor. You can do that yourself. So I think that that in and of itself suggests that management, the board, they know they're overvalued. And I think investors should take that message away. There may be another leg in marijuana, but I think it's going to be in technology, extraction, value added. I think the growers, the LPs, I think that game is over for now. They have to do a lot of work to justify their valuation. And that's 2, 3, 4 years out. And if they don't get that legalization next year, as everyone hopes, they're in for a rough ride.
One of the aspects of the market we'll be keeping track of for you is in the area of financing, which companies are raising money. We've got one this week for you. It's called Edgewater Wireless, trades on the venture. YFI is the ticker. The company raising up to $3 million through 12 million units, and they're doing it through a syndicate of underwriters led by Canaccord Genuity. So there's Edgewater Wireless raising some money. Now, one of the CEO interviews that we have for you this week is with the chief executive of Legend Power Systems. They have a patented, fascinating technology that's used by the likes of Loblaws and by IKEA and Canadian Tire, and it is used to reduce the company's electricity usage. Randy, just a basic question off the top for those who don't know what your company does. What exactly do you do?
Well, what we do is address a problem that is apparent worldwide in the overvoltage problem in the electrical grid. So what happens, we've got aging technology that has to provide overvoltage to businesses, commercial buildings, schools, etc., because they need to deliver from the utility source to the end of the line person running a business or having a school, whatever, enough voltage to make sure the person at the end of the line has enough voltage. So everyone along the line is getting what we call overvoltage or too much electricity and paying for it. What we do is we help reduce that for each building and turn the voltage down to a level that the appliances will work best at, but also will save money and turn back the unused electricity back to the grid.
So give us a real-time example of how it works and what it looks like.
Sure. I mean, the best example I can use, if you want to take a Canadian Tire store, everyone can visualize a 100,000 square foot store. What happens is the electrical source comes in to an electrical room, and that powers all the different loads or different lights and things that there are in the building. So in that store, you'd have an electrical room. Our system goes in. It's about the size of a typical fridge freezer in a kitchen. And we connect to the grid and we turn down like a big dimmer switch, or what we call tap down, the voltage that's coming in to a level that the building appliances work best at. That gap between what's coming in before and has been turned down by our system is the excess waste or over voltage, and we eliminate that and make sure that you're getting the voltage you need to run your buildings at the appropriate level.
Is your company a pioneer in this field, and are there others sort of nipping at your heels or who do something similar?
Yeah, in North America, no. What we've seen is transformers as an ability to tap down or reduce voltage in buildings has been around a long time. But the problem has been, specifically in North America, your voltage isn't constant. So what happens is if you manually adjust a transformer to reduce the voltage and your voltage environment changes, vis-a-vis your voltage goes either higher or lower, you can actually have your transformer had reduced your voltage goes down below a level that the equipment will work, and your building goes dark. So what we have, and it's a patent, and back to your original question, we're the only one that does it, is we have the ability to dynamically adjust the voltage, and we have patents, etc., technology that we have that will do that dynamically, right on the spot for making sure there's no adverse reactions or voltage issues when you're in your building.
You mentioned Loblaws, that's a client, Canadian Tire, Loblaws, yes. IKEA, yes. Some other ones. So let's say with IKEA, for example, yes. From before they use the harmonizer, your main product, to after, what are the savings like for them? Sure.
Well, let's stick with the original one just for a second. So if you take the Canadian Tire store in Lakeshore, their payback was 1.8 years. That means after the capital cost of the equipment, after the incentive provided by the utility, which is 25 to 30% of the capital cost of the project, when you add that all in and the energy savings on a monthly or annual basis, it took 1.8 years for the product to be paid. So in that example, we have a 10-year warranty on our product. There's no cost once you buy it. So from 1.8 year payback on to 10 years, approximately 8 years, the product worked maintenance-free and it has no cost to it. In the IKEA examples, they vary. Some of those were 4 to 6 year paybacks, but regardless, we still look after it and guarantee full warranty for 10 years.
Let's talk about some of the financials for your company. Record revenue in the most recent quarter, margins of 51%. The order book looks pretty strong. Give us a sense of of going from startup to growth now?
Sure. Well, startup to growth is a good way to summarize it. Startup to me is you're still evaluating, making sure your product works, your revenue is very lumpy, you're relying on particular accounts to drive your revenue. And I think we've crossed that chasm and really entered the stage of growth. So what we have is a proven product, over 170 installations in North America, demonstrable savings in 13 different verticals. We're really pleased with the results of the product. And now we've moved out of that proven startup component to be a growth stage company by building up our sales team, et cetera. So we're seeing and expecting continued quarter-over-quarter growth in all categories. And we think the last quarter we announced some records will be just the start of some good things that are starting to happen for us.
So your business is primarily in Ontario. You're branching into the U.S. Northeast. Give us a sense of the potential in the U.S. and also the challenges there.
Sure. So we always knew that we had to build a model that worked before you could take your business into a new region. And I think the mistakes people do is they try to go too large of a geographic coverage and they get mistakes and they can't really address them. So what we did, we focused on Ontario because the rates of electricity were high. We had some proven testimonial accounts, good incentives. That was our base. Let's build it out and prove it and go to the Northeast USA. Why would we do that? North America, it's a $38 billion potential market for our verticals that we're focusing on, huge market. Secondly, is electrical rates in the Northeast USA are even more expensive than they are in Ontario. They are great incentives. They're early adopters. There's a lot of older buildings that need to be retrofitted and can't be taken apart. So they just add up to great opportunities for Legend Power. And a natural being in Ontario and Northeast USA is we're on the same time zone and we can leverage the skill sets of the people in Ontario.
Lastly, Randy, if I were to ask you to, well, I will ask you to basically talk to shareholders or potential shareholders, what are the key factors as to why somebody should own your stock?
Yeah, I think we're out of that startup stage, but we're still on a capitalization that probably reflects that. I think as we get more demonstrable results quarter over quarter, people will reflect that the business actually is substantially ahead of where it is reporting. By that I mean we've got a lot of inroads on the sales sides, we've got a lot of flow of deals, a lot of activities, we're adding the right people. So I think it's a great inflection point for people to get involved in a company that I believe has got a proven base to build off and build into the USA. And the third part of that would be also that we leverage people that we're already dealing with. So in our component of sale, we have a product and we also have people that do the installation. So the people in the States, et cetera, can do the installation for us. It's about a third of our over capital sale, but they can do it without any additional cost to their equipment, people, et cetera. So we're creating a new profit stream for them. So it's an exciting time for us to bring that product to the USA. Yeah, we've got the right people and products, and we think it's a great time to be a shareholder.
Several weeks ago in our Capital Ideas Digest, we did a story on 39-week highs and 52-week highs and how stocks that hit those levels often go on to higher highs. That's because smart institutional money is often moving slowly into different sectors and rotating into different stocks, and they often move higher. So let's take a look at some of these stocks. You've got the Keg Royalties Income Fund breaking across the 22 level recently and then breaking out to 3 new highs after the initial 52-week high. Another one worth looking at is Sonopta. Similar story here, in a range around the $10 mark, breaking that and then hitting 3 new highs to the upside. Conversely, we take a look at CPI Card Group, which is heading in the opposite direction. Oftentimes when stocks are hitting highs or lows, they overshoot in either direction. That's the case here, as CPI Card Group has hit 3 52-week lows in recent days. A number of companies have been sniffing around smart employee benefits lately. They could be an attractive target. They have 2 businesses under one roof. One is IT, the other's on the benefits side. They're both highly integrated. And we talked to the CEO, Jim McKim. So John, your company has been described as almost 2 businesses in one. You've got the IT side, of which a lot of your business is with the Government of Canada, and then you've got the benefits side. So could you explain exactly what Smart Employee Benefits does and how it sort of breaks down?
Well, Smart Employee Benefits is really just one company, and we are in the technology business. Our specialty is business process automation. Now, in providing, we provide software, solutions, and services. So everything that we do on, as you characterize it, the IT side of our business, are skills and expertise that we need on the benefit side of our business. Because on the benefit side of our business, that's all about processing. It's all about automating the processes by which health benefits, whether they're funded by employers or funded by government, that whole back office processes. So we're really a back office processing company where its roots are all in IT. So everything we do in IT is required for the whole benefits processing business.
Am I right in saying that the benefit side of the business is where the growth is?
There's growth in both sides of the business. The IT side of the business, the margins are much lower. The margins on the benefit side of the business are quite high, much higher than they are in the IT business, because all of the solutions that we provide there are SaaS or BPO solutions.
Sorry, what's BPO?
Business process outsourcing.
Okay.
And so the margins are really like software margins more than they are like service margins. But we need the service side of the business to support that business model on the benefits processing.
Now, an analyst I was talking to who follows your company suggested that maybe down the road you look to sell off the IT business and be strictly benefits. Would that make any sense? The way you're describing your company, it's quite integrated.
We do require the services and the support of the IT part of our business. So we've received several offers in the last while to buy our IT business, and that's a $100 million business, and we have about $450 million of backlog in that business. A big part of that is government, and 74% of that is government, healthcare, and primarily. So we could partner with that business or merge that business with another entity, and we are having those type of discussions, and would create a much larger entity, but we would always be a partner with that side of the business.
I see. So you bought Aon Hewitt fairly recently. Tell us about that deal and what it's done for your company.
We didn't buy Aon Hewitt. We bought the administration business in Canada.
I see, okay.
For 48 clients. And now we're a strategic partner with Aon. So we're really the technology enabling partner, and Aon is one of the largest benefit consultants in the world, whether it's pension or health and welfare type consulting. So we really become a technology partner with Aon, and the administration business that we bought is 48 clients, over 250,000 employees, and over $1 billion of premium.
Tell us some of the names who are clients, because some of them are quite impressive.
Yes, there are some, they're all household names. I probably actually shouldn't discuss who the names are, but you know, if you pick the 10 largest companies in Canada, 7 of them would be clients.
All right, fair enough. Tell us about the transition that it sounds like you're trying to make from paper-based claims to being strictly online. Am I right in saying that there's a fair amount of fraud in claims and you want to clean that up and make it more progressive and advance it? In the benefits administration and adjudication and reporting and claims payment, the technology systems are very old. For example, you've got 75% of the adjudication, which is the decision making behind paying or not paying a claim, on COBOL and old Visual Basic systems that are 25, 30, 35 years old. So our technology platforms, the processing side of the business is disaggregated. So you have various administration platforms. It seems like everybody has an administration platform of some sort. You've got a half a dozen major adjudicators, mostly old technologies, but you don't have really integrated end-to-end systems. What we've done in the last 6 years, we've invested over $25 million in buying, building, and licensing software, and we've integrated that software to create end-to-end platform. It's one environment, one processing environment, one benefit card for all benefit types. Okay? We have real-time reporting, real-time fraud identification, real-time analytics. That doesn't exist with anyone else in the industry. Interesting. Speaking of other people in the industry or other companies, who would you say your main competition is?
There's a lot of competition, but it's disaggregated. For on administration side and consulting, you know, you literally have hundreds and thousands of brokers that deal with the clients. On adjudication, you've got 6 or 7 platforms, major platforms in the country, primarily old technology. And there's a whole host of disaggregated systems that support an ecosystem for processing. So there's a lot of competition, I guess, in that sense. In terms of an end-to-end solution, we're the only end-to-end solution that I know of in the marketplace where everything can be done in one environment.
John, is there any desire on your part to expand the company beyond the borders elsewhere?
We have had multiple overtures in the last 18 months from a number of companies. And one of the situations that we're in discussion with right now is a private equity fund out of Washington who have done a roll-up of third-party administrators and organizations called professional employer organizations, or PEOs in the States. Now, we have complete platforms for automating the processes in those organizations. So we're in discussions right now about white labeling our solutions into a U.S. partnership with this private equity, where we really become the technology enabling partner. And they have the clients, but we put their business processes effectively on steroids, where right now the majority of those processes are manual. And with the Aon transaction, that's a little bit of what we do as well. We're really a technology enabling partner for Aon, who still have the client relationships, and we have the direct client relationships. So we're really the administration partner to their consulting practice.
Let's talk about the company's debt. You restructured it recently, am I right? And where do you stand there? Are you more nimble now in terms of your debt situation?
I did an acquisition in December 2015. And when we did that acquisition, we assumed a fair bit of debt. We had a little bit of difficulty, more difficulty than I anticipated in refinancing that debt. So we had some very high interest debt for a while. So we've recently closed a $22.5 million financing with one of the major Canadian banks, and which obviously they're not going to loan to us unless they have some comfort level. So that was a $12 million operating, 10.5 term. That really consolidated the majority of our acquisition financing, saved us about $1.5 million a year in interest rates. But the big thing is it termed out a lot of our acquisition debt 4 to 5 years. So today, about 35% of our cash flow is required to service our debt, which ends up with a lot of free cash flow, and that business is growing exponentially.
And lastly, you also did an equity raise recently, $5.9 million. You took more than half of that. You own about 19.9% of the shares. What do you think that says to shareholders, that you have skin in the game like that you have such a large position?
Well, when I started the company in January 2011, I was in the middle of some other personal things, so I didn't have as much capital available to fund the company at startup. So I took a lot more dilution than I wanted to take. The stock price for a long time was 50 to 60 cents. And when I did the acquisition, the stock price fell to the 20-cent range. So the equity that I did, it was a good opportunity for me to increase the position because I had available cash that I didn't have back then. So if I could have bought more than 19.99%, I would have. But the rules say that if I buy more than 19.99%, I have to make a takeover bid. And I didn't have quite enough money to make a takeover bid, but I was quite willing to buy quite a bit more stock. And so of the 5.9, about 5.2 came from a combination of myself, family members, trustees, of assets that I have, of other insiders, and people that have been shareholders from day one. So the majority of those, that funding was all raised by me.
That's our show for this week. Thanks a lot for watching, and thanks for investing like a pro. I'm Mark Bunting. We'll see you next time.